All right. Good morning, everybody. Short week. Keep that in mind through the whole week. A lot of people don't even show up this week, and we'll see more and more in that as we get closer to the end of the year. It's just the way it is. When I was new to trading and focused on day trading nearly exclusively, I didn't understand why so many people would take off. Like, the market's open. What are you doing, fools? Get in here. Let's trade. Let's make some money. But over time, you get to realize that there's good markets and not so good markets. And sure, there's the opportunity that we could have a good day, that it could be just beautiful price action, nice turns on the corners, and just a really good trading day. But more often than not, holiday trading is kind of janky. The flows are off. A lot of the tools that we use are off. They just don't function the way that they normally would. So it's a good time to study, to develop new trade plans, work on some trade drills. And sure, if you get a setup, why the hell not? Go ahead and take it. But I wouldn't anticipate that you're going to get really great setups on the short week. That's just the way it typically goes. So, if you temper your expectations a little bit, in psychology, unrealistic expectations is the angst of most people's problems. So dial them back and you won't be disappointed. Looking at what's going on, we're a little green. We've got European Central Bank, Christine Lagarde, out this morning, and really that's the biggest thing today. We got some auctions, but they're in the front end. A lot of trader talk about perhaps, maybe we're going to go ahead and get that rate cut after all. So we went from, yeah, maybe we will, then no, maybe we won't. Okay, kind of, maybe, sort of, we will. So if you remember Thursday into Friday, this was down in the 30s. And now it's back in the 70s. And this is what helped fuel that reversal, right, that we saw in price action. So keep your eye on it. You don't have to stare at it all day long, but we don't want to see this reverse and get back down below, say, 50%. It needs to hold these elevated levels. The market is addicted to it and it wants it, and it's going to throw a temper tantrum if it doesn't get it. Not really much of a surprise there, right? So it's all about the rate cut. And we're not necessarily in the camp where bad news is good and good news is bad. Because, of course, if we get bad news, it's more likely we're going to get a rate cut. I don't think we're in that spot yet. That dichotomy has eluded us at this point, but that could begin to be a thing at some point. Looking later into the week, CPI, PPI, jobs numbers. But for today, front end auctions and European Central Bank speakers. And then we go quietly into the close. By the way, guys, I know in the morning briefing, we go through some concepts that are uniquely mine. If you have questions, this isn't really the forum, right? Kind of on the clock. I need to get it done, wrap it up, and send you guys on your way. So put your questions in the chat. Send me a DM, something like that. I'm more than happy to explain what I'm doing, what tool I'm using, what I meant by a certain comment. I just don't want to sit here for 2 hours in a morning stream answering questions, because none of us have time for that. So use the chat or just send me a DM. I've been doing these for a couple of years, so usually I've got a resource to help you understand something, either from blog posts that I've made or videos that I've made. And if not, well, then I'll still be able to explain it. This is CTA positioning with the backdrop of the S&P. We can see the first withdrawal where they just kind of lightened their load a little bit. They were all a little ahead of their skis. So they dialed back their allocation and then was in a holding pattern, and now they're pulling back even more. They're not in the negative, right? They're still above the zero line. They're just dialing it back. And quote, smart money has been wrong before, or they are way too early. It happens, right? Just look in the past at how often they got out and the market just kept right on chugging to the upside, breaking new highs and going into, expansion territory while they're still selling out of it. So this by itself isn't enough to act on. It's just showing us that CTAs are still reducing their net exposure. Okay, I mean, it's good to know, but that's not actionable by itself. Gold, they're in this tight little consolidation here, like they're trying to figure out what they want to do with it, or they're waiting on news or something. They're not up at previous extremes, and they're not dumping it. So they're just sitting on pause. All right, Gamma Lab had a lot of stuff from Goldman Sachs. So if you already get stuff from Goldman Sachs, it's not going to be anything new in there for you. But for the rest of us who don't get regular Goldman updates, there's a lot to digest in here. I haven't had a chance to go through it all, but one of the posts from Goldman was this. This is AI platform stocks index. Earnings per share of typical stocks relative equal weight S&P 500. Look at that. Forward earnings. We've been talking about how they're pulling forward earnings in NVIDIA for like 2027 right now. But it's a big company. Imagine all those smaller little mom and pop and those Bitcoin miners, kind of lump them in there. There's a lot going on, a lot to digest. I will work my way through this and see if there's anything actionable in it. Getting to be a regular occurrence with Thinkorswim where I'm having to reload it. I think I got a bad indicator in there. It happens. The call and put wall didn't change. They're still in the same spot as they were last week. Or on Friday, I should say. The zero gamma and the volatility trigger, I believe, did change. I just haven't updated it this morning. But the call and the put wall are the same. 109,000 in the overnight. So we're a little above normal on the volume, but we haven't done anything. You know, we didn't get a decent move through the kill zone. We're very likely going to close this liquidity gap and then what? We're running zipper on VWAP. We're still inside yesterday's range, which happens to be a really big range. You can see the expectation of a rate cut as the reversal on Friday, but we're still stuck inside it. So whether that attribution holds or not, we'll see today, I guess. 10-week right over our head. The 10-day also, the 3-week, and the 20-day, along with zero gamma, volatility trigger, and a couple of random spot gamma levels all rolled into one. So there's a lot of resistance overhead we would have to try to work through. It's not to say that we can't do it, right? Price can do whatever the hell it wants, but we're going to need some real good fuel to get that done. What's going to bring the heat at this point? Let's get these levels updated. All right, zero gamma and volatility trigger are almost on top of each other, and they're now tangled a lot better with the 10-day and the 10-week. So it's just a significant amount of junk right over our head. We can see on the daily, we've got the 50 there too, right? 10-day, 20-day, 50-day, all over our head. We've got to deal with. I've still got Thursday's midpoint marked out, 66.71. We're holding above the mid from Friday, and that's a really good start. We need to keep that. It's 6,600 round number. If we can get and stay above the half, 66.50, because we're running 50s, it opens the door to 67.50. But we got to get above it and keep it. Otherwise, dropping back down below the half offers us the midpoint of Friday, 6,600. Below that, another half, 65.50. Cutting that offers 64.50, level by level, right? So we've got this nice little zone going between Friday's close and Friday's high. Not a bad place to be, but it's a tight range, and we're not going to be able to keep this spot forever, right? Don't care where you go, just can't stay here. GTFO, right? If we look at what's going on, we have this wave that we've been tracking, and we were looking for the next lower low and the next lower high. So we had the lower high. We had this low, but it wasn't a lower low. Now we've got our lower low. And we pulled away from that low on Friday to close in the upper part of Friday's candle. But we need to leave this and continue on. If we don't do that today, and instead we come back down and we break Friday's low, then this low that we're looking at won't be the lower low that we count. Just like this one looked like it was going to be a lower low from that, but it was a one-day wonder, and we turned around and kept going, and so we didn't end up counting that. So we need to see how today plays out before this 66.50 low becomes the lower low that we're going to use. Now, I'm personally not using this as a lower high. It doesn't suit me. So I'll be looking for something else. It's easy to get stuck in the weeds with this current shape, but if you back it off a little bit and just look at it from a bigger picture perspective, one, it's just a big old topping pattern, and topping patterns do not have to end with us being rolled over and going back down. Two, an argument could be made that it's a little bit of a head and shoulders pattern, ugly as it may be, it's still there. But three, we've just got this matching bottom right now, right? And matching bottoms is more of an inverse cup and handle than it is a double bottom. The textbooks, in my opinion, never really did a good job of distinguishing between the two of those, except that one is bullish and one is bearish. So I came up with my own little interpretation a while back. I've talked about it more than once. If this is the low and we only match it, then we don't have a trap where we've trapped bears and could fuel a rip to the upside. Because if the bears didn't get in the trap, then how could we have trapped them? We need to exceed that low with a new low, something like 111 or 1236, get that reversal. And the violence of that reversal is fueled by the bears having to buy back their shorts and the buying that turned the market in the first place. And you get these real beautiful reversals, strong pushes to the upside. But it has to exceed the previous low deep enough to get those bears in there. Otherwise, if it's matching lows, it's more of a cup and handle inverse or a cup. Whether we get the handle would be maybe we get the handle, maybe not. And then down we go. So inverse cup and handle bearish, double bottom bear trap is bullish. We just need to see which one of these we're going to get. And right now, that's an inverse cup and handle right now. So either we exceed this low and we get lower and we get that double bottom that we're looking for, or we set a handle on this thing and we expand. When it comes to the expansion, how low can you go? Is that like limbo talk? Yeah. 64 and 92 cog line is the 111 and the 1236. We would be looking for the reversal somewhere in here to trap those bears and run it back up. If instead this is an inverse cup and handle, then the textbooks will tell you mark the 50 and mark the 100. So 50% is there and 100% is there. 63.32 cog line and 61.25. That'll cut you underneath the 20-day moving average. On the SPX, building out some butterflies around the 200-day moving average, not a bad idea. We don't have a market backdrop that would anticipate a 2022 bear market type situation, right? So even if we do get nasty and get down into like 63, 62, 61, we're not expecting to stay there. So maybe even some broken wing butterflies or some ratio flies wouldn't be a bad way to go at this point, right? All right, they're not hedging this morning. Nothing that they're doing is showing up as additional protection. We're still inside day and we haven't tagged either edge of the ADR. That is the expectation for today. That even if we do something, that something is very likely going to equate to the same thing that we've been doing on average, right? If you look over here, the 21-day average daily range, 21 days, that's a market month, basically at 20 days. You just need the extra 1 day for the math to fit. So I built that ADR indicator for me to answer a basic, simple question. In the last month, what's the average daily move of this particular product? Whether it's the ES, Apple, I don't care what I put it on, right? I'm just wanting to know, what do you do on average? Because, Tesla can make a 5% move day after day after day after day, and nobody will blink an eye, right? It's Tesla. Who cares? You get SPY moving 5% in 1 day, people are going to care, right? That would freak people out. So you can't just jump on a market and not know what its normal move is, right? What's its rhythm? How far does it go on a day-to-day basis? And things are typical for a reason. What it did yesterday, it did the day before, and it did the day before that. And what's our expectation today? That it's probably going to do the same damn thing it did yesterday. That's normal. That's what we want to know with the ADR. What's the norm? Unless we step outside of the boundaries of normal, we're going to stay inside those two red lines. That is the ADR. But if the market was bullish at the open or bearish at the open, and I mean the 6 o'clock open, not the 9:30, then we could have moved the entire distance in one direction, bearish or bullish, right? Because it's the same measure. Only instead of splitting it in half, where we could go half up, half down, we could actually just be bullish all the way in one direction. It would still be the same number. So the expectation for today is we're just going to stay in this 100-point range. That's all it is, right? 99.5. It's a 100-point range, and we could bebop inside of that all day long and get nothing done except heal and correct. We do need to correct. Today's floor pivot is lower than yesterday's. That's bearish. Price opened above it, and that's bullish. We haven't hit that floor pivot yet. It's still below us. That's a missed daily pivot. And the expectation is that we're going to hit it because that's what we do generally. The thing is, we can't count it as a missed daily pivot today, because at any point today, we could run down and hit it, and then it wouldn't be missed anymore. It'd be found. So keep your eye on it. To get down and hit that, we'd have to get inside the central pivot range. That would be the channel that you see around it. And then after we hit it, we would want to test the bottom side, see if we can break out of it, get it into the RTH open of Friday, and then the RTH low of Friday, and then the Friday real low. Along the way, we've also got 65.92, 65.50, and 65.32 cog line. Those would be nice levels to tag on the way down. Otherwise, from the kill zone shenanigans, which these aren't even the kill zone. If you see it, it came in after the kill zone ended. If you haven't heard that phrase before, the kill zone, it is a time period between 2 and 4 a.m. Some mathematicians or statisticians or quants or some dudes was running some math formulas trying to figure out, if you're looking at a 2-hour period in the market during the day, day after day after day, statistically, where's your biggest move going to be? Knee-jerk reaction, I think most people would probably say the open. 9:30 open, 2-hour window, It's probably where you're going to get statistically your biggest moves of the day or the close, right? Power hour, that sort of thing. Nope. Statistically, the biggest move in a 24-hour trading period, day after day after day after day, is the kill zone. It's between 2 and 4. I didn't name it the kill zone, right? Somebody else did long ago. I just like the name and it's easy to remember, and that's what I call it. So it's that 2-hour window. Well, if you go look, that's Europe's open, right? Not US open, Europe's. So if you're awake at that time of the morning, for those of you lucky enough to live in a time zone where that's your daytime, you've got just this wonderful opportunity. And a lot of times it'll just reciprocate. So you'll get the move between 2 and 4, and then it'll just unwind that move and go right back to where it started, which is usually what I end up trading because I'm not up at 2 in the morning. The move is done by 4. I get up in the office around 4-ish. Yeah. Yeah. And then run it back up in the other direction. So there you go. The kill zone. But we didn't get a kill zone move today. After 4s when we got the move. And while it's not exactly a liquidity gap, it does seem like we're going to run back up there and then we'll see what's what after that. We are tangled up in the weekly floor pivot right now. Being above that is broadly based market bullish, and below that, broadly based market bearish. It's not just the ES market we're talking about. It's like the entirety of the index. We would look at, broadly speaking, the market index to be healthier or bullish above the weekly and weaker and bearish below the weekly. When we're tangled up with it the way we are, though, we're just crisscrossing back and forth through there. Doesn't really help, doesn't really count. We do have S&R lines to lay out on top of this, but with the moves that we had Friday, there's really not a lot of expectation for what we're going to get here, right? So R1, we need an inside day breakout to get there, and it's 66.92 cog line, or just in front of 6,700. S1 is the RTH low or close to it from Friday, but still inside day. So if we can get through the floor pivot, that's the goal. There is a logic that says R1 S2 or S1 R2, but we're not at either one of those today. And whether you run ADR halves or you run SNR1, that's pretty much the range that we've got for today. Unless somebody is going to put some gas in this thing and fire it up. We need fuel. And not that sugarcane gas either. We need the real stuff. I used to fly to the rig offshore, right? Take helicopter flights, get out to the drilling platforms. One of my first helicopter rides, we were taking off from Lafayette, Louisiana. Storm all around us. Lightning hit the airline fuel tanks. They exploded. Oh, that was a big explosion. Back in like 2003 or 4, 5. Turns out jet fuel makes one heck of a bang. After that, we started taking boats from Pouchon. All right, so last week's distribution looks pretty good. We're tangled up at the point of control. We've got this really big day to contend with, and it's not just in the ES. A lot of markets have that big Friday bar that it now has to deal with. The ones that get through that the fastest and can expand, whether they're headed higher or lower, they're the ones you want to keep track of. They're going to be the market drivers. For everybody else, they're looking for fuel, and those that make it may very well become that fuel. But for right now, anything trapped in this range, which is very likely 80+% of the market trapped inside of its own range like that, kind of validates the idea that we're not going to get much done today. We've got to figure this range out, get through it, work beyond it. Once we do get through that high node zone, it thins out quite a bit, and then we've got a smaller distribution above 6750. And that distribution is 3 weeks deep. Then it got shallow on that week, and then we're back into it again for another week. Boy, this is an ugly chart. 10-day, 30-minute volume profile in TPO. The TPO doesn't look that bad. It's the volume profile that's just all over the place. Multiple distribution zones. Thin areas that we could cut through before we land into the next pot. So 6650 to 6750, it gets shallow, but then it bolds up. This is, right back to that argument that we're running 50s. Yeah, Vince, I will reach out to you after. There's in the YouTube description of this, I've shared most of the charts that I use on a day-to-day basis. And then there's the Thinkorswim workbook and like the 9 videos that I made on how to set up your Thinkorswim so that it functions a lot like mine. Not because I thought everybody should have theirs looking like mine, but because I teach where the settings are and how to change it so that once you know how to do it, you can make it look how you want it to look. So there's nothing here. I did get your email though, and I'll send you something. We're going to be losing these candles on the left for every new candle we get on the right. The point of control is already down here with us, so we're not looking for any movement, right? Nothing new on that unless we break out above that 6750 and we put a lot of work in up here. We could drag that thing behind us on each level. You guys seen those videos where they're like climbing up a wall and there's ledges, and then they pull the ladder up and then they climb that ledge, and then they pull the ladder up and they climb that ledge? That's kind of what this reminds me of. We can get up to this zone, bring that point of control up, gives us some solid footing, make a run for the next spot, bring that point of control up. If you haven't seen that video on YouTube, then I don't know. Check it out. We got a new VPOC from Friday's price. Looks like 83 or 84. I don't run ticks on this. I just run the whole number. So yeah, 83 is close enough. VPOC, if we break to the downside, we're going to have to contend with that. The one that we had on Thursday, we bumped against it multiple times in the Globex, but once we got into the RTH, we ran right through that thing. It was interesting that we buzzbeat off of it on the other side. Once we got through, we pulled back and checked it from above. It's that old validation that old resistance becomes new support, which is what I call a buzzbee, just because I got tired of saying that phrase over and over again. Old resistance becomes new support. So now 65.83 is the point of control from yesterday, the VPOC, since we haven't hit it, and we'll carry that forward until it gets hit or we get a new contract, because we are going to be getting new contracts. For today, the distribution looks good. No discrepancies that really stand out. Just a nice tight little range. Now on Friday, we measured the anticipated range and we set it out there, and you can see how much it lost between Friday morning and Friday at the close. This box was how wide it was projected to be Friday morning, but it tightened up. So now we can look at what we actually do have versus what the projections were, and we can compare that to last week. Even with that, this week's range that we have is wider than last week's range. And there's a lot to digest with this. One issue is that there's the math of how these ranges are built. There's two pieces of numbers that are going into this. One is how many days do we have? If last week and this week both have the same amount of days, then that's equal. And then there's, well, how much volatility do we have? So typically we have 5-day weeks. When we compare one week to another week, since the days are the same, the only thing that really changed was the volatility. And then we can apply that to how wide the gap is. But this week is one of the shortest weeks in the entire trading year, right? It's not a 4-day week, it's a 3.5-day week. And yet the range is bigger. So they're pricing in a lot of volatility, a lot of volatility. And unfortunately, we can't even quantify how much volatility are they pricing in, because there's no way to run that kind of math, right? All we can say is the market is protected against big moves in either direction. Their trades within the, because I'm looking at the ES, if you went to the SPX or some other market, then that's what they would be trading. Their trades in the options in this market are what move the levels on that weekly expected move. If they trade wide out of the money positions, that's what's going to make that thing get the levels that it has. So they're pricing in the expectation of big moves, and they are hedged against left and right side tail risk. If it was just one-sided, we'd see it. They're running it either direction, which means they don't know. They're just, hey, if we make big blowout moves to the upside, they're going to get paid. And if we make big blowout moves to the downside, they're going to get paid. And it's short duration. It's only for next week. They're, this week. They didn't run this for like some bigger picture hedge or trade that they put on. It's just for this week. And it is every week, right? They'll run in every week and build out positions for what they think the next week has to offer. That's why I look at the expected move every week. Now, just because that's what they are protecting against doesn't mean we're actually going to get it, right? They can, a lot of times, they'll price in these really big expansion weeks thinking, oh man, next week it could be these really big moves, and then we get no move at all. Why? Because once they hedge that big move to the hilt, then there's nobody caught off on the wrong side. Nobody's caught unprotected, and the threat of that big move never materializes because nobody's scrambling for the exit, right? Remember, what moves markets is often fear and greed. So markets don't like surprises or getting caught on the wrong side. Everybody's scrambling to join on one side or the other. But if you can see the threat coming and you hedge it to the hilt, then there is no threat, at least not to you. And if enough people do it, then we don't get the move. We're below the 10-week, just barely. been a while since we've been down here and actually stayed for more than a week. The last time was through the March, April shenanigans. Right now, we need to see how long we're actually going to hang out here before we turn things around and get back up above it again. The problem is if we don't get just a dip and run and we end up staying down here for a little bit, it can stick and we can stay down here for a couple of weeks. If you look back, that's the way it usually goes. It's either one and done and we're back up and on the run, or we're stuck for a while. There's a few occasions where we had just a 2 or a 3 day event below the 10-week. A few, but it's not as common as getting under there and holding there like that one and that one. And though that's like two different events. This one. So we're under it. If we really start to expand below the last low that we've got here, let's just call it minus 1%. The likelihood that we're going to keep it and stay below the 10-week for at least a month goes up exponentially. That kind of sucks, but that's the way it is. You know, if you do the math, though, that might tie us right into the last week of December. Sure does. Yeah, that might not be a bad thing. I have to look at the almanac, see what that seasonality is for that last week. All right, the VIX is down 4%. It's down 9% over a 5-day period. Nat gas, bonds. Well, Thinkorswim says bonds, but Thinkorswim's got an issue with TNX and TLT. So I almost never look at them here. If you're on Thinkorswim and you want to look at the 10-year, use the 10-year futures. It's a better way to go, right? It's /10Y. The Mag 7 up volume is up 3.5%, but it was down 12% in a 5-day period. And now it's getting a little bit of a bounce. Granted, it's a violent bounce, 3.5% move, but it was down 12% in a 5-day period. Of course, it's bouncing. So don't read that as bullish by itself. That's just a very violent, bullish bounce in a otherwise bearish backdrop, right? And some of the biggest bullish bounces we've ever had in history came in a bear market environment. So by itself, just because that one's up 3.5% this morning, don't let that make you think the day is going to be a bullish day or that the week will be a bullish week, because we needed a bounce just to maintain a healthy backdrop. China's up, more China, Bitcoin, the Mag 7 again. And this one wasn't as bad. It was down, what, 3.5% ish. Now it's still down 2% over a 5-day period. China, gold miners, chips, growth, bots, communications, tech, lots of tech, all kinds of tech is in here, and that's good. We've got the sectors we need for a rally day: consumer discretionary, multiple types of tech, communications, chips. We could easily rally today with this. The only thorn in the side of all of that is that we were down so much that a lot of this stuff that's up really just looks like a relief bounce after falling, more like a dead cat bounce than anything else. and it's going to have to prove that that's not what it is. Some of these you have to be careful with, like cloud. That thing will show you Friday after hours rather than, pre-market Monday. So when it comes to cloud, you want to go look at the chart itself, at least on Thinkorswim, because yeah, it'll get after hours and pre-market muddied. Then you'll think it's moving this morning when it wasn't. It was just moving after hours on Friday. All in all, it's a fairly simple day today, right? We've got a decent range. The gap is closed. Get out of the box. If we can get out of the top of the box, we can challenge Friday's high and make a run for it. I would be looking for a 111 and a 1236 if we break out of Friday's high. Because remember, it's supposed to be a range day. Even if we do get the breakout, it's supposed to be a range day. So I'll be looking for that 66.92 reversal. Yesterday's 111 is one of my favorite trades. Or the 67.11 cog line reversal. Either one of those. Because even though it's called yesterday's 111, sometimes we actually make it up into the 1236. If we get through that and we don't come crashing back down, then it's game on to the upside. But I'll take that short anyways, probably, depending on how it looks when we get into it. Because it's an LRE, low risk entry, and it's worth being wrong. We'll see how that plays out. To the downside, same thing. Break our own Globex low, challenge the mid. Then we get into Friday's levels. Friday's open is a level to keep track of, right? 65.81. Always the previous day's RTH open is a level that you want to know. That one people sleep on and they don't even pay attention to it. Get through that, you got Friday's RTH low and then the full low, and then it's game on to the downside, level by level by level. So all we got to do is get the heck out of this box. Once we are outside of that box, you got to get out of Friday's box. And once you get outside of that, then you got the full day of Friday. So to the upside, it's just 2 levels. To the downside, it's 3 levels. Not much to it. Should be a decent trading day because there's plenty of room, right? It's a very large, wide range. But as long as we're inside of this little Globex package, you don't have much of a range to deal with. So what I got for you guys, be careful, be safe, watch the clock. I'll see y'all tomorrow.